Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us understand today the admission of a partner. Before understanding admission of a partner, let us understand first what is partnership firm. We have a act called Partnership Act 1932. As per the Partnership Act 1932, relationship between two or more persons is called as the partnership firm, and they are coming together to share the profits and any of them acting for all. Then admission of a new partner. When the old partner get deceased or retired of a old partner, when partner is aged, then or death of a partner, then new partner will be admitted. When new partner is admitted, consent of mutual consent of all the partner is compulsory. With the consent of all the partner only you can admit new partner. Then, when you admit new partner into the firm, the existing agreement comes to an end. A new partnership starts. That is why you have to create new books of accounts and admission of a partner is done. Let us understand what all the adjustments takes place in account and what is the meaning of admission of a partner and partnership firm. According to Section 4 of the Indian Partnership Act 1932, the term partnership refers to relation between the two or more persons who are agreed to share the profits of a business carried on by all or any of them acting for all. Section 31 subsection 1 of the Indian Partnership Act 1932 provides that a person can be admitted as new partner only with the consent of all the existing partner unless otherwise agreed upon. As I already stated, it is with the consent of all other partner only, that is existing partners only, you are admitting a new partner into the firm. And here a new partnership firm when takes place, that is when you admit a new partner, it is called as reconstruction, because old agreement comes to an end. That is why it is called as reconstruction and new partnership begins. What are the adjustments takes place when they admit a new partner? Let us understand the accounting adjustments are required for the admission. You need to compute new profit sharing ratio for the partners. Then you need to revalue assets and liabilities to know the increase or decrease in the value of an asset and liabilities. You need to distribute reserves, accumulated profit and losses to the partners. You need to adjust goodwill, and you need to adjust capital contributed by the new partner to the existing partner, and adjustment for the life policy of the partners, and what you are supposed to do and what you are not to do, and all recorded under the agreement. The agreement is called as partnership deed. It is terms, what is profit sharing ratio, interest on capital, everything will be recorded in the partnership deed, and it should be duly stamped as per the provision of the Stamp Act and signed by the all the partners. Let us understand the contents of partnership deed. The contents of partnership deed is name and address of the firm, name and address of all the partners, profit and loss sharing ratio, rate of interest on capital, loan and drawings, salary, commission if in case payable to any partner, settlement of account on dissolution of the firm, rules to be followed in case of admission, retirement and death of a partner. And the account which are maintained under the partnership firm is two accounts are maintained for the capital account. Fixed capital method under fluctuating capital method. Under fixed capital method, the capital of the partners remains same year after year, because here under fixed capital method two accounts are prepared: capital account, current account. Under capital account only the opening balance of capital in case of any addition to the capital and any withdrawal of the capital will be shown. That is why here under fixed capital method the capital remains same. and all other adjustments related to the partner, that is salary of a partner, commission of a partner, drawings, interest on drawings, interest on capital, all those adjustments will be shown under the current account. Under fixed capital method, we are preparing two account: capital account, current account. Capital account, only the opening balance of capital, addition of capital and withdrawal of capital will be shown. Current account, all the adjustments will be shown. Under fluctuating capital method, all the adjustments, opening capital and any withdrawal, addition to the capital will be shown under capital account only. And here the capital of the partners fluctuates. Let us understand the pro forma of partners capital account under the fixed capital method. Partners capital account, opening balance, capital is the liability, so opening balance we are recording under credit side, opening balance of a partners. Then any addition to the capital will be recorded under credit side in the bank account. Then if in case any withdrawal, it should be debited under bank account, and closing balance will be recorded under debit side. Then we are preparing the partner's current account. Under partner's current account, in case any opening balance of current account is there, that should be credited. Here, partner's current account we are preparing in the point of view of partner. So, income of the partner, whatever income to the partner will be credited, whatever expenses to the partner in the business will be debited. So, salary should be credited, commission we are crediting, interest on capital, on their capital whatever they have invested, on that they are getting a interest. So it is an income to the partner, that is why we are crediting interest on capital. In case of profit, it should be credited, profit and loss account or appropriation account. Then drawings, whatever they have withdrawn in for the personal purpose, it is called as drawings, that should be debited. And because they are returning back to the company, that is why interest on drawings they are returning to the firm. And closing balance, in case any current account closing balance is there, that should be debited. This is about the partner's current account. Let us understand under fluctuating capital method, partner's capital account. There are two accounts you are preparing. No, here only single account you are preparing. All the opening balance should be credited, capital. In case of any addition, bank account, and salary, interest on capital. In case of profit, in case of loss, we are debiting. Drawings, interest on drawings, then closing balance should be debited. This is about the pro forma of capital account under fluctuating capital method. Let us understand this with this question. Sanjay and Sagar are partners with capital of rupees 15 lakh and rupees 10 lakh. So what is the capital? This is opening capital, opening balance of partners 15 lakh and rupees 10 lakh respectively. They agree to share the profit in the ratio of 3:2. Show how the following transaction will be recorded in the capital account of the partner in case the capital are fixed and the capitals are fluctuating. So both the method we need to show. The books are closed on March 31st every year. The closing the books of accounts on 31st March. Here are the adjustments. Additional capital is given, that is introduced on July 1st. Whenever we are calculating interest on capital, we are considering additional capital also. And from the date of introduced or whatever invested, from the date of investment to till the date of books of accounts closed will be calculated for the interest on capital. Interest on capital percentage is given 5%. Drawings 30,000, 20,000. Interest on drawings 1800, 1200. Salary only for the Sanjay it is given 20,000. Commission 10,000, 7,000. Share in loss for the year. Loss is given 60,000, 40,000. Let us prepare the partner's capital account under fixed capital method first. Okay. Under fixed capital method, the The format for the partners capital account is we have debit and credit, left hand side and right hand side, two amount column for Sanjay and Sagar, and particulars column. First we need to record opening balance of the partner capital. Opening balance by balance brought down. By balance brought down, it is 15 lakh, 10 lakh. Then we have addition to the capital, that is additional capital. We are crediting in bank account 3 lakh, 2 lakh. There is no withdrawal of capital. That is why we are closing the partners capital account to balance carry down. Total, here it is 18 lakh, 12 lakh. 18 lakh, 12 lakh. Now whatever you have carried on, you need to brought down by balance brought down 18 lakh, 12 lakh. So we have prepared the partners capital account under fixed capital method. One more account we need to prepare under fixed capital method, that is partners current account. For current account there is no opening and closing balances given, but interest on capital is given. Interest on capital. Let us calculate interest on capital. Interest on capital we have Sanjay, Sagar. First for the capital, opening capital we are calculating 15 lakh into 5%, 10 lakh into 5%. 15 lakh, 15 5 is 75, 75,000, and here 50,000. Now for additional capital also you have to calculate interest on capital. Additional capital 3 lakh into 5%, and 1st July it is introduced. From 1st July to 31st March it is 9 months. For 9 months we are calculating the interest on capital. 9 months it is 11,250. 2 lakh into 5% into 9 by 12 is 7,500. Total here 86,250, 57,500 is the interest on capital. Interest on capital 86,250, 57,500. Then we have salary. Salary by salary, only for the Sanjay we have 20,000 nil. Then commission 10,000, 7,000. Then we have interest on drawings and drawings. 2 drawings 30,000, 20,000. Then interest on drawings 2, interest on drawings 1800, 1200. Then we have loss. Loss should be debited to profit and loss appropriation account 60,000, 40,000. Now all the adjustments are recorded. Total here credit side is more, so closing balance will be debited to balance carry down. Total is here 1,16,250, 64,500. 1,16,250 minus 91,800 is 24,450. 64,500 minus 61,200 is 3,300. Total 1,16,250, 64,500. And balance brought down by balance brought down 24,450, 3,300. Now let us prepare partners capital account under second method, that is fluctuating capital method. Only one account we are preparing. First we are recording opening balance. This by balance brought down 15 lakh, 10 lakh. Then we have additional capital by bank account 3 lakh, 2 lakh. Then we have interest on capital. Already we have calculated interest on capital is 86,250. Then 57,500. Salary 20,000. Then commission 10,000. 7,000. Drawings 30,000. 20,000. Interest on drawings 1,800, 1,200. Loss we have that we are debiting appropriation account 60,000, 40,000. Now closing balance is here. Total is credit side is more 18 lakh plus 1,16,250 you will get 19 lakh 16,250. Here 12 lakh 64,500 is the total. Now what is balancing figure? To balance carry down 19 lakh 16,250 minus 91,800 is 18 lakh 24,450. 12 lakh 3,300. See, 12 lakh plus 3,300, 12 lakh 3,300. 18 lakh plus 24 to 450 is 18 lakh 24,450. Total is matching, right? When we are prepared both 19 lakh 16,250, 12 lakh 64,500. Then closing balance by balance. Closing balance here we have recorded that we are whatever we have carried on, we need to brought down the closing balance. that is by balance brought down 18 lakh 24,450, 12 lakh 3,300. So first we have prepared under fixed capital method two accounts, that is partners capital account, partners current account. Under fluctuating capital method we are preparing only one account, that is partners capital account. Yes, I hope you all understood the partners capital account under fixed capital method and fluctuating capital method. Let us understand now profit and loss appropriation account. The name only says it is once you find out the net profit, from your profit all the adjustments, appropriations, the extension of profit and loss account is the profit and loss appropriation account. This profit and loss appropriation account shows whatever you are distributing among the partners, the adjustments from the profit, whatever you have distributed, that adjustments will be shown under the profit and loss appropriation account. So this is the pro forma of profit and loss appropriation account. Net profit should be whatever you have carried down here in the debit side of the profit and loss account. Here you are brought forward that profit into the credit side by profit and loss account. In case of loss, you are recording debit side. Then interest on drawings. See, profit and loss appropriation account is a company, firm's point of view you are preparing. So whatever income to the company, whatever income to the company you are crediting, whatever expense to the company you are debiting. Interest on capital, it is an expense. For partner it is an income, for the firm it is an expense, so you are debiting. Interest on capital, salary, commission. Okay, let us understand this with a simple question. Here we have a question. Preeti and Prema commenced business with capital investment of rupees 80,000 and rupees 60,000 respectively on 1st April 2022. They agreed to share the profit and losses in the ratio of 3:2 for the year ending 31st March 2023. They earned a profit of rupees 24,000 before allowing the following: interest on capital at 6% per annum, annual salary to Praveen rupees 5,000, interest on drawings Preeti 1,500, Prema 1,000, partners drawings Preeti 15,000, Prema 10,000. From the above, prepare profit and loss appropriation account for the year ending 31st March 2023. Let us prepare profit and loss appropriation account. Yes, profit and loss appropriation account for the year ending 31st March 2023 credit. First, we need to record the net profit of the firm that we are crediting by profit and loss account. 24,000 is the profit of the firm, that is net profit of the firm. Then we have interest on drawings. Interest on drawings. Preeti, Prema. 1,000. Right. Then interest on capital. So interest on capital. What is the capital introduced? Preeti capital. It is 80,000. Interest on capital percentage is 6%. 8 6 are 48, 4,800. For Prema, it is 60,000 into 6%. 6 6 are 36. 3,600 is the interest on capital. And we have salary to Preeti. Salary to Preeti 5,000. We have recorded all the adjustments. Now our credit side exceeds the debit. What is the total? 24, 25, 26, 500. 26, 500. 26,500 minus 5,000, 3,600 and 4,800. That is 13,100. That is to profit and loss appropriation account. Appropriation account. This you need to distribute in the ratio of their profit sharing ratio. Preeti and Prema. 13,100 into 3 by 5 is 7,860. 13,100 into 2 by 5, 5,240. This is about the profit and loss appropriation account. Here you need to understand appropriation account you are preparing in the point of view of firm. So whatever income to the firm you are crediting, whatever expenses to the firm you are debiting. Okay. I hope you all understood. Thank you for watching. Have a great day.